A lot of people are aware of the January effect for stock markets. Usually when January is up for the S&P, it usually carries through because it sets kind of like the mood and the sentiment. And it has a high probability, but we also discovered this for the Bitcoin market. So of the last 6 times that Bitcoin was up in January, the price has actually kept on rising until year end. And when we look at the last 2 times this has happened, Bitcoin prices actually rallied 100%. So they doubled from their February 1st level.
We're talking about the cycles of Bitcoin with our next guest, Markus Thielen. He is the head of research at Matrixport, and he has worked as a portfolio manager on the buy side of many institutional firms, including JP Morgan. Welcome to the show, Markus. Pleasure to host you today.
Thanks for having me, David.
Markus, you are also the author of a new book called Crypto Titans, How Trillions Were Made and Billions Lost in the Cryptocurrency Markets, in which you analyze the history of cryptocurrencies and the evolution of Bitcoin and the other cryptos. A very interesting book. We'll talk about some of the major themes towards later on in this interview. Let's start with recent market action first. Bitcoin, for the first time in a long time, has broken the $30,000 mark. Now, the question is whether or not this momentum could be sustained. Now, you were telling me offline that you think now is a constructive macro environment to long Bitcoin. Can you give us your thesis here?
Yeah, thanks, David. So of course, the number one reason is that the Fed is sort of like pausing with their interest rate hike cycle. And as you have seen over the last kind of like 12, 18 months, when the Fed hikes interest rates, that's usually quite negative for risk assets, notably Bitcoin. And I think we're seeing now how Bitcoin has already rallied this year in anticipation really of the Fed stopping back. And it seems also that market participants are really underweight equities. We know, for example, from the CFTC non-commercials futures data that shorts in the S&P 500 are actually the largest they have ever been. And those shorts, is really like an expression that people are really bearish and probably not really fully overweight US stocks. And I think if US stocks rally, crypto will rally. So I think in the macro environment looks very positive right now.
I'll just clarify, this is actually the first time since last June that we've seen $30,000 Bitcoin. So it's been a while. It's been a year. So people are definitely seeing more hope. I'm curious as to understanding your macro thesis a bit more. Most economists, well, not most, but a majority of the economists I've spoken to are bearish on not just the economy, but also risk assets overall. And if you were to take the stance, I'm not saying you have to, but if one were to take the stance that the stock markets will fall later this year, can Bitcoin still rally despite a stock market correction, Markus?
Well, I think there have been periods, of course, when Bitcoin is very sensitive to the macro environment, where Bitcoin is sensitive to the stock market, but it's not always really sensitive, right? It really depends if Bitcoin itself can really form its own narrative because there's a new bull market, there's a new theme developing. We don't see this right now. Of course, some of the BlackRock news about launching an ETF, it can be a driver, but of course, this is just a flow argument, not really a new thesis for a bull market. But I think on the other side, I'm quite bullish on stocks because we have, again, people are really short. People have been anticipating a correction, which has still not occurred. And I think people are underperforming, right? We're seeing this, that hedge funds are underperforming. We're seeing this, that really active managed funds are performing versus the markets are going up. And at one point, those people have to admit that they have been wrong. They have to, adjust their expectations. And I think we start to see this actually from some of the sell side firms, Morgan Stanley, JP Morgan, Morgan Stanley, Goldman Sachs. They have all been really negative this year, as you correctly said. But some of them are really like throwing in the towel and saying like, well, we might not go down, we rally a little bit more, but they're not as bearish as they were at the beginning of the year.
Do you think that the application filed by BlackRock for a new Bitcoin spot ETF has any material impact on sentiment for the industry?
Yes, 100%. And I think the playbook is very similar to December 2017, when the Chicago Mercantile Exchange, the CME, launched the Bitcoin futures. And also back then, we had like a monster rally during the year in anticipation of those futures being launched. And I think we can see something very similarly, that really it's like buy the rumor, sell the fact. But I think we are still several months away until those ETFs being launched. But nevertheless, I think that this is a big sentiment driver and a big money flow driver. And when you look, for example, at like gold ETFs, physical gold ETFs like the GLD, has like $58 billion of AUM. You have some others, from spiders to other gold ETFs. So there's around $100 billion in gold ETFs. There's like, one, even a silver ETF has like a 10 billion. I mean, to imagine that a Bitcoin ETF that is, properly regulated, listed in the US, trades in the US, is accessible for US retail, for US institutions. I mean, that this ETF can attract 10, 20, $30 billion over a few months after launch. I think that's really, quite possible. And I think this will be a big driver and big sentiment for really the crypto market.
Let me just present a counter argument to the adoption thesis that a lot of people are talking about. So yes, you're right. It definitely provides another avenue to adopt Bitcoin, but institutional investors have already had other ways before. If you look at Grayscale BTC Trust, for example, that was one way. If you take a look at Bitcoin miners, like just off the top of my head, Marathon Digital has a lot of Bitcoins on its books. It's basically a proxy for Bitcoin. Another proxy for Bitcoin is MicroStrategy, and these are all stocks that institutional investors are able to buy without breaking any investment mandates. And of course, the retail investors have always had spot Bitcoin. So the counter argument here is that one extra Bitcoin ETF is just one extra way to adopt Bitcoin. It's not going to make a tremendous difference because you have to consider there were already ways to adopt Bitcoin before. How would you respond to that?
Yeah, I think that's actually a very interesting question. I mean, I'm of course very familiar with the GBTC Grayscale trust. I've been involved several years ago myself. So of course here the difference is that this Grayscale ETF doesn't really trade at a proper exchange. It trades at a side exchange. Volume is not really large. The bid offer spread is wide. It trades at a discount where there's a large discount to the NAV. So basically there's no proper value mechanism because the shares cannot be destroyed, they cannot be redeemed. And I think that's really one of the key differences where people they can buy, but they cannot leave and get out because they have to sell it to someone else. And I think that's one argument. And I think the other argument, as you said, the miners, well, as we know that in a bull market, you shouldn't really buy the companies that are mining gold, producing gold, or anything of the other commodity companies, because they simply very often make the wrong decisions in the cycle. If the cycle is very bullish, they expand, they're buying other miners. Again, as we have seen from the gold market, where the gold mining shares tend to underperform gold bullion itself during a bull market. And I think this is very similar probably with the crypto market, because all these miners, they just have very different cost and different cost structure. They depend on labor laws, they depend on energy costs, they depend on land rights and everything, versus Bitcoin is just the smoothest way. And if it's in your portfolio, then you probably also can cross margin it, you can borrow against it and everything. So I think there's a lot of value proposition, but it gives you the cleanest approach. And I think that is really the key difference, right? And even, the other argument that you just mentioned was MicroStrategy. And I think on this note, MicroStrategy has spent $4 billion in buying Bitcoin from the market. And I think today they're just back to break even, because I think their average price is actually 30,400. And we are right there for the first time, as you said, in over a year, really. And I think the difference here is, of course, that they're also starting to engage in some financial engineering. Of course, they're issuing some bonds and buying Bitcoin. They're leveraging up the company. And, buying Bitcoin through a BlackRock ETF, you wouldn't have all these things to worry about. And I think that's kind of the clearest way, and I think the simplest way for those investors to buy Bitcoin.
There have been many attempts to create a Bitcoin ETF in the past, many attempts to file applications. Do you think the regulatory environment has changed enough so that this time would be different? This time we'll finally get an approval?
Yeah, I really think so, because BlackRock has a very good track record. They have applied for 575 ETFs in the past, and only one was rejected. So they have a really high success rate. They already launched an ETF for their private clients already last year in August. So I think they can go back to the SEC and say, we have ample experience in working with the right service providers. And I think that's a strong argument why they could really get get through with this application. And we have seen, of course, a lot of other companies have filed, before them, but after they have filed, they have also jumped on the bandwagon. So it's not just them waiting in the, in the wings. There are a lot of other companies as well. So I think there will be a lot of marketing machinery from Wall Street, really making really the waves and bringing people into the crypto market and especially into the Bitcoin market. And I think this is going to create really tremendous waves this year.
What's your outlook for the price of Bitcoin? Do you have a year-end target for us?
So one methodology we used, this is something we published on February 1st, basically, which is the January effect. A lot of people are aware of the January effect for stock markets. Usually when January is up for the S&P, it usually carries through because it sets kind of like the mood and the sentiment. And it has a high probability, but we also discovered this for the Bitcoin market. So of the last 6 times that Bitcoin was up in January, the prices actually kept on rising until year end. And when we look at the last 2 times this has happened, Bitcoin prices actually rallied 100%. So they doubled from their, February 1st level. And I think, we're around like 22,500 by end of January. And this is why our argument was back in, February 1st, that we might actually rally until like 45,000. And I think when you look how the market has evolved this year, we have moved up, 10,000 points, we traced 5,000 points, moved 10,000 points, we traced 5,000. So it's really this 2 steps up, 1 step back. And I think the scenario, so that's why I think 45,000 is really in the cards, especially with this BlackRock ETF news now.
Some would argue that's not a tremendously bullish environment considering the bull cycles we've seen in the past. So would you say that this is probably a consolidation pattern or the beginning of a bull cycle?
It could be the beginning of a bull cycle. I agree that, even kind of a 300% return that we have seen then from kind of the end of December 2022 levels to then 45,000. So it's around like 250, 300%. So it's not really, a lot to write home about, for the Bitcoin market when you look at some previous bull markets, as you said correctly, but it's still a respectable return. And I mean, if you can make even like 30% from here, it's not too bad. And I think historically, when we had really these large Bitcoin bull markets or crypto bull markets, there was really like a big, defining theme. And I think we don't really have this right now. The argument is really on the one side that the macro environment is in a better setting. And on the other side that we're seeing probably now a lot of inflows on the flow side, really, from large institutions into Bitcoin. But there is no really underlying technological change that we have seen in other bull markets here.
In your book, you've outlined the 4 bull markets that cryptos have seen in 2011, 2013, 2017, and 2021. I'm curious to understanding what you found in your research, the differences between the bull markets, the different drivers behind the bull markets, and how these bull markets have evolved in their root causes.
Yeah, I mean, one factor is, of course, that we have seen with each bull market, there were new exchanges being set up and new instruments really being the driving force. So, the first bull market in 2011, it was really just Mt. Gox, just buy some Bitcoin. And if you don't like Bitcoin anymore, you just sell them and your position is like 0. And then we came into the second bull market, was 2013. Suddenly you could actually also go short Bitcoin. And this is why some of those crypto exchanges that really came out of that bear market that followed the second bull market, did really well and had the firepower to stay around. And of course, the bull market of 2017, we suddenly saw really like leverage players really entering the bull market where you had like 10-to-1 leverages, ratios. And of course, the leverage ratios, went up to like 100 or 125 times. And of course, then on the fourth bull market, there was, of course, you got the automated market making. So there was always like some technological improvement. And I think that's kind of on the one side that the exchanges were being built out and, developed from really like a long only market you can buy to, a more financial engineering market. And of course, there were also like really different themes, right? So the first bull market was just, Bitcoin was just seen as a peer-to-peer payment method, right? We, of course, became very popular on Silk Road, on WikiLeaks, on those sites were really, they were really like in the gray area of the law, as most people would say, and this is why Bitcoin maybe has gotten like a bad rap initially. But then, of course, the 2013 bull market was really more driven by China. So we had something similar where there was a financial crimes enforcement law act being triggered in the US in early 2013. So this caused that some of the crypto industry moved away from the US, moved into Asia, because China became extremely favorable. And I think that's kind of like a bull market, can elaborate a little bit more, because there were some interesting facts happening in China, and people are really not aware of the magnitude what was happening there. And then, of course, the 2017 bull market was more kind of like an ICO craze. Bitcoin or crypto was seen as a way to raise money. It was really, private markets became really popular. Uber the ride-sharing app stayed private for a lot longer. So for people to get access to the private markets, they thought crypto is a way. And then, of course, the 21 bull market was mostly driven really by the yield farming craze. And I think that was also like a big driver. So it's really, on the one side, we have these exchanges providing more and more products for investors. And then on the other side, is the fundamental driver. But, we don't have a fundamental driver yet, but I think it can develop because there is more interest now after we're getting out of this bear market.
So here's where it gets interesting, Markus. With every bull cycle, there comes a bear cycle. Do you think that the causes of collapses for the crypto prices in the past have been more or less the same?
They're actually very similar. And I think this is why, history sounds a little bit boring for most people. But I think in this case, it's extremely valuable to understand, because the 2017 bull market, it really peaked with the exuberance and the expectation of the CME Bitcoin futures being launched. And it was really launched 3 days from the top. This is really, you really need to think about this, right? It really, we came from a level of like 1,000 and rallied all the way to 17, 18,000. And we really peaked within 3 days of the launch of this, Chicago Bitcoin futures market. And it might be very similar now that expectations are really rising. But I think the fact is that, what brought the market down in 2018 was the SEC was declaring certain projects, certain tokens as securities. And this had really like a negative vibe. There was a lot of enforcement action, and a lot of people, of course, forgot about this already or weren't really in the crypto industry. And this is what it really helps to understand. But I think what I also, and this was kind of like my biggest takeaway from the book, is really there are around like 420 million people that holding cryptocurrencies. There are like 600 million people that downloaded a crypto trading app. So it's very difficult to put the genie back in the bottle here. And I think it's just not going away because there's just like so many people involved with.
And you've discussed, in your last part of the book, you've discussed the scandals that have rocked the crypto industry in 2022. Were there any similarities between the collapses of Celsius, FTX, Lunaterra? Were they idiosyncratic, firm-specific issues, or was there a larger underlying issue that you've discovered?
I think the commonality was really that you really had on the one side all these lending firms, and they basically had more or less like two clients, and the clients were really, Alameda on one side, and Three Arrows, on the one side, and you had like Celsius and BlockFi and everybody else, Voyager, just lending to those guys, and those guys were the ones, willing to bet enormously, and it just went wrong. But I think there were, unfortunately, a lot of scandals. There were a lot of lies. There were a lot of, I think, miscommunication. And I think that's really like unfortunate, but I think it's an important lesson to understand. And this whole trust of keeping your coins on the exchange, I think this is just going to slowly go away now, especially because the market is now evolving and developing in a very different direction, where in TradFi, you cannot be everything as an exchange is right now, right? A crypto exchange, it's your prime broker, it's your matching engine, it's your OTC desk, is your prop desk, is everything. And I think in TradFi, these things are like all broken down into different silos. And I think we're going to go there now, especially because you have these institutional players now really entering the market. And, we had, of course, also for Fidelity and Citadel and Virtu, they're also working on an exchange there. So I think there is a lot of stuff happening and the market will materially change.
Markus, some people have said that the crypto industry has become even more risky than what we saw before the fall of FTX, precisely because the collapse of major exchanges has completely eroded trust from the system, from the crypto ecosystem. And so now I think consumers and investors alike would like to understand whether or not the risk profile of investing in cryptocurrencies has significantly deteriorated over the last 2 years.
Yeah, I think I would argue quite the contrary. I mean, again, if you look at the history of cryptocurrency exchanges, most of them went down, the same way. There was, most of them have done some proprietary trading on the side where they lost money that they were not supposed to do. Some of them got into trouble with the Bank Secrecy Act. I mean, this is something that might be still raised around Binance, and that's still waiting that the Department of Justice is going to come out. Of course, we have heard about the CFTC and the SEC, filing lawsuits against Binance. We have not heard about what the DOJ thinks yet. And in the past, we have seen, a very, very similar progress. But I think every time a big scandal has happened, kind of this door was a little bit closed. And I think the main risk that really retail investors or anybody else who trades on the exchanges has is really that the exchange is really misappropriating those funds and lending them out to other parties. And I think this is really going to be really blocked now and very scrutinized from really the regulator in all these jurisdictions. I mean, we have seen, for example, that in Japan, and I think a lot of people are not aware of this one, but in Japan, they passed laws in 2017 and 18 that required really exchanges to put like 95% or more really of their holdings into cold storage, into cold wallets, really. And I think this is why the FTX customers for FTX Japan actually didn't really lose any money, because the exchange was mandated to put the money away. And I think we're going to go down this route. And some countries were just kind of like really like slow to adapt these laws. But I think there are good precedents. And I think that's really going to help the consumer, to feel a lot more confident about it. And I think the sentiment has actually not changed. I mean, of course, we don't see those altcoins anymore, and this is like slightly different story. But I think we don't see some of the altcoins from the previous bull market. But I think we're seeing the sentiment is still there for the key tokens or the key cryptocurrencies like Bitcoin.
Gary Gensler has actually 2 weeks ago in an interview with Bloomberg, he made the remark that the crypto industry has always had a history of commingling funds. It's just the norm, which is unusual for other industries but common for cryptocurrencies. And he was specifically talking about Binance. And so, do you agree with this remark that the crypto industry, exchanges in the crypto industry, have always had a commingling of funds problem?
I wouldn't say generally. I'm sure, I would say, let's say 50% of exchanges have probably done this because, again, they weren't really siloed, those different business units. And initially they started out as a matching engine, and because of, client requests, they ventured out into other areas. But again, I think the issue, for example, with Binance is not really of like commingling funds. I don't think that's the issue. They are more like other compliance issues, and that the company has actually admitted to it, and the company, wants to kind of pay, I guess, a fine as they have said previously, and move on from it. But I think we have seen this, of course, on FTX that really were like lying about it. But again, I think going forward, it seems very clear that institutions that are coming into the crypto industry, and this new exchange, for example, that is being set up with Fidelity and Charles Schwab, and I mean, this will be just simply an exchange that really matches the trades, but everything else like custody and so on. I mean, this will be all handled by other entities, and I think this is really key, that those units will be broken down and those business decisions will be like separated. And I think that is really key. And I think going forward, we don't need to necessarily talk about an old problem anymore, because the solution is like very easy to implement. And I think there are these large companies, that are focusing on custody. There are companies focusing on matching engine and everything. So again, these are all separate entities, and I think you don't have this conflict of interest anymore.
What do you think are now the major risks then, looking ahead for investors, if some of these risks that you just talked about are a little more mitigated, so to speak?
Yeah, I think mitigated is a good term, but of course there's always, the price risk. There's always the risk that the market will come back, that, from an adoption and a perspective, that's of course always a risk as well, as with any technology, that it becomes like obsolete. But I think the risk is a little bit still on some of those kind of like smart contracts. We have of course seen, some, from contract exploitations. And this is because there were simply like bugs in the software. And I think that is still a risk. And I think that's why, going down into like some protocols that people, are not very familiar with, that are very technical. And then those things can still be exploited because, kind of the security measures are not around, and, somebody smarter found a way. We have seen this, of course, with Mango markets that could be exploited. And with other protocols. But of course, Bitcoin seems to be like fairly safe and fairly easy to understand for people.
The other big concern that I've heard is that there is a risk that Binance could lose this lawsuit, be shut down, or go bankrupt like FTX. Now, if that were, I'm not saying that they will, but if that were to happen, this would essentially be the end of crypto exchanges because nobody will trust exchanges anymore. Do you think this risk has any significance whatsoever?
Oh, not at all. I mean, I agree that there is a very dark cloud and a very negative overhang. And I think there is a possibility that, yes, they could lose the lawsuit because it seems like they have like key people really working together with the prosecutors, within, from the Binance organization. They have clear evidence of some chats and some client flows and so on, apparently. And the judge has to decide there, what is really, what is really the final point. But I think we can look back in history, and then we realize that actually every 3-4 years, there were new crypto exchanges really coming up and really leading this, I guess, evolution really within the cryptocurrency space. So, Binance also came from, the rise of Binance was also associated because another exchange, ran into trouble. And when this exchange ran into trouble, and it was one of the leaders, if not the leader back then, Binance market share went from 10% to 25%, really literally overnight. And I think, the other exchange was like nobody, 3-4 years before that, and some other exchange was really there, the leaders. We have heard, of course, Mt. Gox, and Mt. Gox went under, and of course, Mt. Gox doesn't exist anymore. So I think it's a natural progression, unfortunately, that crypto exchanges kind of, strive for 3-4 years and then being replaced because there is some regulatory overhang or some other issue, some issue with their own software, trading software, or in the FTX case, some misappropriation of user funds. But I think it's just unfortunately like a natural progression. That's why it's very keen to have your coins in a really safe environment, either on your, in your own self-custody, on a secure custody, or really have it with somebody who follows a safety and custody procedures.
You brought up Citadel and Fidelity. So this week, EDX Markets, an exchange that's been in development for several months, just launched, and it's been backed by Fidelity and Charles Schwab and Citadel. And it's interesting because now the crypto exchanges are facing, I would say, more serious competition from traditional firms in the same realm, if you want to call that. Are they competing for the same clients first and foremost?
Yes, I would think so. I think there's a huge risk that those exchanges now lose a lot of valuable flows and valuable customers, because in the end, I think it's very difficult to also justify for an institutional player really to trade on some, second, third tier exchanges where there is some risk of jurisdiction, where is some risk of execution, where is some risk of, client orders first, and a lot of stuff, other stuff that maybe some of those exchanges have embedded in them. So I can really see how this, the crypto trading market is actually now being rebuilt for for institutional investors, then I think this will drain a lot of the flows from those smaller exchanges and really help those large players and really have the migration of volume really to those exchanges, because they're just like, some serious players there suddenly.
You wrote extensively also about the emergence of DeFi in your book. I'm curious, Markus, which technological advancements that came from DeFi can also be applied to other sectors outside of cryptos?
Actually, that's also like a very interesting question, because the crypto industry thought for a long time that TradFi has to change and adapt to DeFi eventually, because DeFi was all about cutting out the middleman. Especially a lot of the financial institutions have large middle and back office personnel that can all be like automated. And I think crypto is just like a natural extension of really this automation, cutting out the middleman. But I think it needed to be a little bit more in a kind of KYC, know your client, and in an AML, anti-money laundering setting. So I think it seems to be a little bit that, in the first step now, that crypto needs to adapt, or DeFi needs to be adapted a little bit more to TradFi because of the regulatory environment. But we, of course, have heard already that the JP Morgans of the world developing and working on their own blockchain to streamline really this matching. And I think when you look at, for example, like the New York Stock Exchange, it takes like T+2. So it takes like 2 days after the trade that the stock is like cleared and into your account basically transferred. And I think with blockchain, this can be done, a lot faster, but it seems to be that those large institutions are really kind of like winning the game right now, and will deploy some of the DeFi inventions and really, take over now from the incumbents, unfortunately.
And the evolution of DeFi, do you think there will come a point where DeFi will evolve to become a standard form of money? I know this is a very broad question because there's many things within DeFi, but if you were to take the definition of a decentralized asset, could that become a standard form of money in the future?
I mean, I think it can. I think it can. And when you think about it, how, again, it's all about trust, right? Do you believe it? And I think if Bitcoin can really become this unique payment system, and maybe it needs to be, there needs to be more adoption. There needs to be, something else that needs to be broken down into like little Satoshis. We have seen already, for example, and again in Japan, 2017 is a good example, because there are more than 260,000 stores, would have accepted or have accepted a Bitcoin as a transaction mechanism, and you could have actually paid in those stores with Bitcoin. So I think it's just kind of like part of the natural evolution, really, of the integration of technology into our lives. So I wouldn't rule this out, and it's just like another form of payment, and I think it has survived for so long. And I think what a lot of people actually don't realize, also, like 20 years ago, it was Tencent, a tech company in China, that was developing the QQ coins, and they were also quite popular until the central bank shut it also down in 2007. So I think this has been really in a lot of people's, I think, blood, really, in their blood, to really pay with those tokens. There's around like 2 to 3 billion people playing online games every day, and they're looking, all these gaming things that they have as also like as valuable, that they can exchange. So I think there is more acceptance now among the people, and so I can see this really developing as a new payment system as well.
Now, in the final paragraph of your book, you wrote that it seems likely that the crypto industry will experience another bull market due to monetary debasement, the introduction of CBDCs, clearance of regulatory overhang, or the progress in crypto transaction speed and costs. I'm curious to understand why the introduction of CBDCs may be bullish.
Well, of course, the one side, it gives everybody a wallet, right? And it can be used for other things as well. So, you just, it's not that you get them in your simple bank account, right? There might be like a different way. One thing to look also at this is, so instead of having, a hard copy or a paper driver's license or a check card driver's license. You could have just shown your NFT on your card and it would have been universally accepted. I think that would have made a big difference. But I think here with CBDCs, I think it just shows that the government is using crypto or blockchain technology one way or another. And I think this is why the adoption will continue, because if the governments make a small concession into this one area, because again, what is it? It's about programmable money, right? It's, the example that's always being thrown out there is, all these government stimulus money that has been distributed to the people during the COVID pandemic. This could have been also be programmable money, right? You can only spend these, CBDCs, for example, on specific items. There's a timeline. I mean, this is exactly what is programmable money. And I think if you go down this route, then people are becoming also familiar with a lot of other things that are programmable. And I think this is why this CBDC can be actually quite bullish for the market.
Don't you think that if people adopt CBDCs, either by choice or by decree by the government, there will be less need to adopt, let's say, Bitcoin as a form of payment?
Well, I think people will feel probably more comfortable there. I think there's always like a large number of people that probably trust Bitcoin more or want Bitcoin. But I think it's just, it can just exist in parallel. We have, something like 200 currencies around the world, and we still have like 5, 6 major ones. I mean, why not be having Bitcoin as one of the major ones? I think there are enough people who hold Bitcoin. I think the number is just going to go up now, especially because there's going to be a lot of acceptance and marketing, pushed around this because of all these ETF launches that we're probably going to see this year. So I think this is all going to help, for the overall adoption.
In your research for your very thorough book, have you examined or thought about who Satoshi might be?
Yeah, there's one person, who lived in the same town, right? It's right at the beginning of the book, right? But he lived in the same town as Satoshi Nakamoto, and it seems quite interesting. There's a lot of parallels. Unfortunately, this person passed away. He had he was very sick, but he was also one of the core developers of the whole crypto movement, really, in the 90s. And I think this person could very well be Satoshi Nakamoto again, because this person passed away, and we haven't heard from Satoshi for a similar time as this person unfortunately left us.
Are you referring to Hal Finney?
Yes.
Okay. Well, yeah. There's some people agree with you, some people disagree. I guess we'll never know if he passed away. Time will tell. And finally, what's one more theme that's prevalent in your book that we haven't discussed yet before we close off?
I think the interesting aspect is that, some of those crypto exchanges were, for example, launched by also like very young people. And I think this is also like a sign, that even like for young people can have like a big impact. I think this was quite motivating. We have, of course, heard a lot of university courses are offering anything around crypto. So I think there's a lot of interest really there from all sides. But I found this really fascinating, how global crypto is. There's a lot of stories around, how the Chinese entrepreneurs really made these mining machines like so much faster and really controlled the market. At one point, actually, 90% of all the crypto trading happened in China. I mean, this is really just, for people to understand if there's some positive news in China, how this can develop. But again, I think there's like more than 420 million people having crypto holdings. So it's very difficult to really, put the genie back in the bottle. And I think this is really like a global movement that's probably going to continue.
All right. And finally, where can we learn more about your work? I'll put a link to the book in the description down below. But besides your book, which people should check out, where else can we learn from you?
Yeah, I mean, I publish a lot on my LinkedIn profile almost every day. Sometimes I have like 50, 60,000 views. So there's a lot of interest from it. I have a Substack. It's called DeFi on Target, where I also publish kind of like twice a week. And I'm really trying to help people understand, where the price ideally is going. So it's really kind of more analysis focused on the evolution of the price, and really just kind of matching what's happening in the news and how it's maybe related to history, what we have seen. So the book is turning out like a good reference guide. It has been read by some of these OGs in the industry, and it has really been well received so far.
Okay, well, Markus, I appreciate you coming on the show. We'll speak again soon. Thank you very much.
Thanks, David. Thank you for your time.
And thank you for watching. Don't forget to subscribe.